Well, okay, Powell raises by 25 basis points today, the interest rate. He signals 2 more rate hikes in 2018. Now, here's the thing. The Fed estimates show a steeper path for rate increases in 2019 and 2020. The Fed says economic outlook has strengthened in recent months. I'm going to tell you what, they're not going to have a steeper path for rate increases in 2019 and 2020. Because we're not going to get to 2020. It's as simple as that. We're not going to get to 2020 for them to have rates, the steep rate increases that they're talking about. We're not going to get that far. I really, really, really doubt they're going to get through 2018 with the 2 more rate hikes they got coming. Planned for, how many says, that they're planning 2 more after this one? It says there will be 3 or 4 hikes in 2018. They just had 1. So that means 2, maybe 3 more. They're not going to get through that mess. This is like in the old days, the Indians used to have something they used to call a gauntlet. And they would run through what was called the gauntlet. And they would have Indians on both sides. Well, you know, actually that's a misnomer calling them Indians. They were actually Native Americans. They would have them on both sides, the warriors. And they would be flailing this guy. They'd be throwing hatchets at him and everything. And he'd have to run through that and get to the other side. And he'd have cuts and scratches all over him after he run through the gauntlet. And, you know, a memory just went through my mind. You know, on that show Jackass, they made a gauntlet on Jackass, and the guy had to run through it, and it was, they made it out of plywood, and they made obstacles inside it, and what they did was they hung from the ceiling, they hung a whole bunch of tasers, those electrocution things that the police use, you know, and they had them zapping ready, and these guys had to run through it. That was hilarious, you know. Anyway, I'm getting shifted off track here. The Fed's not going to get through they're raising rates. So now, what's just happened? We just had a rate hike, right? Now, hot on its heels on the 26th of this month, the Chinese are going to start to sell oil not in U.S. dollars for the first time ever. And China's too big a country for the United States. The United States just can't go in and bomb them like they normally do. You know, they just get their aircraft carriers on the edge of a country and they just knock it into obliterate it. That's their normal technique to any country that tries to sell outside the dollar, to sell oil outside the dollar. Well, China's going to do it. What are they going to do? Like, China's like, what are you going to do? You're not going to do us the same way you do everybody else. And they're not. What they're going to do is hit them with tariffs. This is why the tariffs. You want to know why the tariffs. This is why the tariffs. But still ain't going to stop the Chinese in doing this. So on the 26th, we got that to look forward to. That is not going to have an immediate effect, but trust me, it will have an effect on the dollar. So we got that coming on. And then on the 30th, just a few days later, on the end of March here, they're going to raise it from from $20 billion a month to $30 billion a month. They reverse quantitative easing. And so that's what we got to look forward through for the next 3 months. Now, that's not going to have an immediate effect either. That's going to have a cumulative effect over those 3-month period. That hasn't been priced in yet. Guess what? Tonight, while I'm speaking, and I knew that this would happen. I've been saying this would happen all along for the last, 3 months. I told you guys when they priced in the bond yields. I told you that it was priced in. I told you that it was keep floating until we got up to the time when they're ready to raise it again. Well, now it's taken off, and now it's going to continue to take off. Now is when we're probably going to go past 3%. Because right now the market is pricing in that new Fed increase. And so I'm looking now at us going over 3% in the U.S. 10-year in the next, like toward the end of this month. And then it's going to continue to increase. So we'll probably be at around the end of this month, we're probably going to be right around 3%. Right? Look for it to increase the yield on the U.S. 10-year. Look for it to increase toward 3.25. Once it hits 3.25, right, then we can have the crash anytime. But it's not guaranteed that the crash will occur at 3.25. That's when we have reached the point where the crash can occur. Okay, so when we hit 3.25, then the crash is ready. In other words, that we're primed. It's kind of like when they prime something, have it ready to go, you know? So then we're primed, we're ready for the crash. That doesn't mean the crash is going to occur. We might actually climb past 3.25. We might climb to 3.3 and 3. And all the way up, maybe even to 3.5% before the crash will actually happen. But we're primed. Once we get to 3.25, we're primed. The crash is ready because we're primed and we're ready to go at that point. We're locked and loaded. You know the old saying, we're locked and loaded at that point once we hit 3.25. So right now we're on the increase. The bond yields are going up tonight while we speak. I think it hit 2.91% on the U.S. 10-year. Look for it to increase. And I'm looking for 3% at the end of this month. And then all next month, I'm looking for it to increase until about the middle of the month, or maybe toward the end of the month, I'm looking for around 3.25. And when we hit 3.25, then we're primed and ready for the crash. That doesn't mean the crash is going to happen. Now, so at the end of April, we should be around 3.25, and then we're ready for the crash. Then the crash could come in May, it could come in June, and it might just hold off. If it holds off, then and they do price it in, when they get probably, I'm going to guess right here. Now, this is just a guess. I'm going to say on the U.S. 10-year, they're going to have it priced in probably when they get around 3.25, 3.35, somewhere along in there, on this next raise that the Fed's going to do. Probably somewhere in there. Right? And so then we're good for 3 months. Once we get it priced in again, then we're good for 3 months. It'll stay around that range. Say it goes to 3.25 or say it goes to 3.35. It'll stay in around that range for those 3 months. Right? If that doesn't do it, then come 3 months later, which would make it July and August, along in there, 3 months after, July and August. What'll happen then is then they're going to raise it again to 40 billion, and the market will price that in. That's when we're going to head to 4%. So if we make it past the 3.35 or whatever percent on the U.S. 10-year, then we're going to go to 4%. And believe me, I really don't think we're going to get past the 4% on the U.S. 10-year before we're going to start to see this thing all unwind. When this whole thing unwinds, it's going to unwind like snap. And the more pressure comes on it, the more it's going to go snap. So the longer it takes before it breaks, the more pressure it's going to break with, if you know what I mean. It's kind of like putting pressure on a coil spring. The tighter you wind the spring, the more it's going to bounce when it comes the other way. And so this pressure they're putting on it right now, this is the pressure coming on it, the Fed, and they're not going to stop. They're going to continue. And they're going to continue ramming the pressure to this thing until it breaks. Now, let's just say it doesn't break in August. Say it doesn't break in August. that it goes all the way into the final quarter. And they increase it to, what is it, 50 billion. Believe me, the 50 billion will do it. The 50 billion will break it. Because then the Fed will be in full unwind. They'll be taking the build-up that they did that created all the stock market, to raise the stock market during the Great Recession of 2008, when the stock market was down on its bottom. What raised it was the liquidity that they pumped in, and that liquidity went directly, it come directly off of their toxic balance book. In other words, you had a 1-to-1 ratio of the Fed taking and dumping this money into the markets, and the markets going up, and it coming right onto their balance book. In other words, the Fed was buying the markets. And I can show you the market charts where each time they started a new version of quantitative easing, the market went up immediately. And when they stopped it, the market went down. So when they stopped the quantitative easing, they had quantitative easing 1, 2, and 3 in Operation Twist. So they had 4 versions of it. And each time they stopped a version of it, the market would instantly start to go back down to where it was again, fall. So then they'd start a new version and the market would start to go up again. And so the market went up and up and up, all based on this quantitative easing. So what do you think is going to happen if they try to reverse the quantitative easing and take all that money back? Well, it's the same thing as if you had an air pump and you pump a tire full of air. Okay, the tire goes up. I mean, that's pretty simple, right? The tire inflates and the car goes back up again. But what happens if you go over and you say, okay, what we're going to do now is we're going to take and we're going to stick our finger in the valve and go, you know, you stick your finger in the valve of the car tire and you hear this sound. Well, it doesn't happen right away. Not immediately. The car tire doesn't go flat immediately. The air's just out. At first, you don't really see a whole lot for the first minute. You don't see much. Don't see much of anything. The tire's still up, but you hear the hissing sound. That's what the Fed's doing right now. They're letting that liquidity out, the exact liquidity they put in, they're draining it out. Right? And they're going to increase it. It's just a matter of time until all of a sudden, poof, that car tire is going to go down, and then suddenly you say, hey, it's flat. It's a no-brainer what's going to happen. I mean, they're not going to make it to 2020. In here, I read this, and it says the Fed says estimates to show steeper path for rate increases in 2019, and then 2020. They're not going to get that far. They're going to have interest rates too high. The market's going to crash. We're going to go into a deflationary funk. It's almost, in my mind, it's not written in stone that we have to have this deflationary funk. Right now, we've got some sort of a little, but created by all of the loose monetary policy. Loose monetary policy tends to have a delayed effect or delayed reaction. So they throw the loose monetary policy out there, and even when they stop it, the momentum carries it on. It's almost like you, if you get out on the freeway with your car and you pump that accelerator down to the floor and you get that car up to, say, over 100 miles an hour, you're not going to be able to stop instantaneously. You're going to it's going to have a delayed reaction of carrying you forward. That's what the markets did when they melted up just now. This is a delayed reaction from loose monetary policy that lasted all those years. But now it's over. They peaked. The markets peaked. They peaked, and now we are seeing the markets. They're not gonna go past that 26.5. That was a peak. We're on our way down now from the peak, and we're getting ready for the crash. Because it's all got to do with the Fed withdrawing that same liquidity they put in. It's like the air they pumped in the tire, pumped it up. Now they're pulling the air out. And they think that they can get away with it. Well, the markets aren't like the tire. The tire, the air comes out in a regulated way. You can look at the tire and you can say, hey, stop. And the tire's only half flat. It's not the way the markets work. The markets work, you're taking the air out, and then all of a sudden it goes boom, flat instantaneously. It looks high, it looks good, it looks up, still looks up, and then it goes boom, bang, it goes flat, you know, and then they're in big trouble. And that's what the Fed's going to do. They're going to keep pushing this thing until it breaks. Look out, because in the first part of this, when it first starts to break, right, your cryptocurrencies are going to melt up. Just like the stock market melted up, right, just before they're getting ready to crash. The cryptocurrencies in the first part of the stock market crash, the cryptocurrencies are going to melt up a little bit. I don't expect them to melt up huge, but melt up a little bit. So what you're going to see is, right now, I mean, you guys could play this if you want with the cryptocurrencies. You're going to see a little bit of a melt up, I think, and especially in the first start of the stock market crash. Cryptocurrencies, I don't know. I'm just going to guess. Don't use this as a financial advice. I'm just guessing right here. But I'm guessing that they might melt up. But Bitcoin might melt up to 12,000. And that would mean, what would the other ones melt up to? If Bitcoin goes up, they all go up. So Bitcoin melts up to, say, 12,000. That's just before the big crash. Because then when the stock market goes below 20,000... the first guys are going to profit take, and they're going to go into cash. They're going to sell their Bitcoin, go into cash, and that's going to create sudden fear, and you're going to see the biggest red candles you've ever seen in your life in cryptocurrencies. It's going to be scary. It's going to be a big candle that just goes straight down, and it's going to seem like it's never going to stop. It's going to drop thousands in one candle. It's going to be fearful, very, very much fear. The market's going to drop below 20,000. It's going to be like a margin call, and then we're going to find out. Then we're going to find out what is the real safe haven assets. And as of this point in time, it's not cryptocurrency. Now, what's going to happen is after the Fed reacts to all of this and turns the situation around on the other side. Because the Fed will react. When they see all these markets melting down, they're not going to sit there and say, hey, you know what, we're just going to let them melt down, and we're going to let the people come and, we're going to let the old ladies come with their canes and beat us over the head because we're not paying their Social Security check anymore. We're just going to let that happen. You got to hope and a dream that the Fed's going to allow that to happen. They're going to step in with monetary policy because they can. They're not going to let these big banks, too big to fail banks go down, including Deutsche Bank. All of them. All of these too big to fail banks, they're not going to let them go under because it would be financial suicide to let them go under. So what they're going to do is they're going to have to come in and support them. And I'm not talking about supporting them with bail-ins. They're going to bail them out. They're going to bail them out. And they're going to do it in such a big way this time that faith and confidence in the dollar is finally going to be lost. This is it, boys. This is the end of this whole thing that goes all the way back to 1971. When they snipped, picture a hot air balloon in your mind as the dollar, and picture all of the other fiat currencies connected to that hot air balloon, and it was connected to gold with a tether. They come along and snip that tether. The dollar started floating free, and it floated with all the other fiat currencies floating free with it when they snipped that tether. And then they reconnected it to oil. Now the oil connection's getting snipped. So it's truly the dollar, for the first time ever, is becoming a true fiat currency. The dollar really wasn't. It was backed. See, all these guys out there have been saying forever, they're saying the dollar's backed by nothing at all. They're not right. The dollar's backed by oil, but the dollar is going to be backed by nothing at all very shortly. And part of this is coming on the 26th of this month. So I hope you guys are ready for all this, because it's happening fast now. It's starting to happen. We got the first part of it today. Today was the first part, them raising the rate. The next part comes on the 26th. The next part comes on the end of this month. And then we're going to see rates rise, which is the next trigger. Directly after that, we're going to see the U.S. 10-year yields rising. All this next month, as they price it in, as they price in what the Fed's going to do at the end of this month. They're going to price it in. I have said that this is going to happen. I said that that the bonds were going to. Let me just look at here and see what it's running right now. On prices, bonds and rates. U.S. 10-year. Okay, she's dropped a little bit tonight, 2.87, but I'm going to tell you, just as soon as the end of this month hits, they're going to have to price that in. We're going to see it go past 3%. I'm pretty darn sure. And this is what's going to happen. Once it goes past 3%, we're entering into the real danger zone. Then that's because they're going to have to price this next Fed policy change. I call it a policy change, but actually it's set in stone that they're going to raise it again to $30 billion a month. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye.